40 years mortgages, the housing trap no one is talking about. What if I told you that the solution being pushed to help first-time buyers to afford a home is actually going to price them out of the market even faster? Yeah, I know that sounds backwards, but stick with me. 40 years mortgages are being promoted as a golden ticket for young Australians locked out of the housing market. You know, lower monthly repayments, better affordability, and finally a chance to own their own home. Wrong, because while everyone is celebrating this solution, there's a ticking time bomb hidden in the fine print. By the end of this video, you will understand the uncomfortable truth about how housing affordability really works and why this help might actually hurt you. Let's dive in. But first, you need to understand how brutal Australia's housing market has become. The median household now needs to spend 50% of their income just to service the average mortgage. 50%. Half of everything that you earn goes straight to the bank. Now, the average mortgage size, it's hit a record of $641,000. That's nearly 2/3 of $1 million in debt. Traditional mortgages in Australia have been 30 years for decades. But on a $641,000 loan at 6% interest, your monthly repayment is around $3,860. That's steep. That's stress-inducing. But for many first-time buyers, that's simply unaffordable. But stretch that loan to 40 years and your monthly repayments drop to $3,500. That's $300 less every single month. That's nearly $3,800 a year back in your pocket. Suddenly, that mortgage looks manageable. The bank gives you the green light and you can finally afford to enter into the market. But here is something interesting. Only 4 lenders currently offer 40 years mortgages, and 3 of them exclusively target first-home buyers. That is exactly why politicians, banks, financial advisors are pushing 40 years mortgages as a solution to housing affordability. On paper, it works. You know, lower monthly costs, more people can qualify for loans, and here is where things get interesting. And by interesting, I mean concerning, because there is another group of people who benefit even more from these 40 years mortgages, and they are not the first home buyers. When the 40 years mortgages became available, they don't just help young couples scraping a deposit together. They supercharge the borrowing capacity of experienced property investors. And let me explain how this works. Property investors have a massive advantage in Australian property market anyway. They have existing equity in properties that they already own, the tax deductions through negative gearing, access to government incentives and grants, and more importantly, they have the experience and the risk appetite. Now, when you introduce 40 years mortgages, something really powerful happens for these investors. Their serviceability skyrockets. Think about it. As an investor with $200,000 in equity from their existing properties can likely to buy a new purchase. On a 30-year mortgage, the monthly repayment maxed out their borrowing capacity at $900,000, but on a 40-year mortgage, those same monthly repayments can now support $1.1 million in borrowing capacity. That's an extra $200,000 in borrowing power just by extending the loan. The demand is there. The 29% of the Gen Z, millennials say that they are considering 40 years loan, and that's nearly 1 in 3 young buyers jumping into the market. So what happens when these investors armed with more borrowing power, more equity, more experience enter into the same market as first-time buyers? They outbid every single one of them, every single time. The first-time buyers who finally can afford that $700,000 home, they're now competing against the investors who can comfortably bid $750,000 or $850,000. And here is the brutal part. The investor isn't even necessarily paying more out of pocket each time than they were before. They have just unlocked more capacity through a 40-year loan structure. This increased competition does not just affect one property. It affects the entire market. When investors can bid higher, seller expects higher offers. Market adjusts upwards, and suddenly that $700,000 home is now $780,000. The affordability that the 40-year mortgage created, that just got swallowed up by the price inflation. Now, historical evidence in the pattern repeats itself. If you're thinking that this is just a theory, that it wouldn't really happen, let me take you back through the history, because we've seen these exact patterns happen before. Australian mortgages weren't always 30 years. Go far back enough and the standard was 15 years, then it became 20 years, 25 years, and finally 30 years became the norm in 1990s. And every single time the standard mortgage term was extended, do you know what happened to house prices? Yeah, they went up. Not immediately, not overnight, but over the following years, as more borrowing capacity entered the market, more buyers could suddenly afford higher prices. and the market adjusted upwards. Then mortgages went from 20 years to 25 years and properties became more affordable monthly, but the purchase price rose to match the new borrowing capacity. When mortgages extended to 30 years, the same thing happened again. Initial affordability gains were gradually eaten away by price increases. Here is the uncomfortable truth that no one wants to say out loud. Extending mortgage terms does not solve housing affordability, just redistributes it across time and benefit those who already have the capital. The first-time buyer gets a short window, maybe 12 to 18 months, where they can enter the market more easily, but then the price adjusts. The market recalibrates and they end up paying more for the same property, just spread over a longer period. Meanwhile, the investor who moved quickly, they've locked in their purchase before the price adjusted upwards. They've leveraged their equity effectively and they're actually eyeing their next investment purchase. And we haven't even talked about the actual financial cost yet. Let's use the actual Australian average mortgage of $641,000 at 6% interest rate. On a 40-year mortgage at the same 6% interest rate, you'll pay $1,050,000 in interest. Your total cost around $1.69 million. That's $300,000 more in interest. A 41.7% increase in interest costs. And let's sink that in. You are paying $300,000 more to save $300 a month. Think about the math for a second. Now, the proponents would argue, but you have extra cash flow and you can invest that $300 and the monthly difference can come out ahead, and theoretically they're right. But if you invest that $300 every single month without fail and earn consistent returns above your mortgage rate and never touch it for 40 years, you might even break in or come slightly ahead. But here's the reality. Most people don't do that. Life happens, car breakdowns, the kids needs braces, the emergency occurs, and that extra $300 gets absorbed into the lifestyle, not the investment choices. And even if you're disciplined enough to invest, you're now taking on an additional investment risk to offset the guaranteed extra interest cost that you're paying. Meanwhile, locked into a decade of debt, 40 years. That's potentially your entire working life. Let's talk about the retirement time bomb. Here is where things get truly alarming. The average first-home buyer in Australia is now 36-year-old. A 40-year mortgage means that they'll be making payments until they are 76. And this isn't just hypothetical. We are already seeing the consequences. The 3/4 of retirees who currently have mortgages owe more than they have in their entire superannuation. The number of Australians aged 55 to 64 who own their homes outright, it's almost half in just 20 years. We're creating a generation that will never experience the traditional Australian dream of owning a home outright in retirement. And think about what that means. You're working your entire life, paying off a mortgage, and instead of entering retirement debt-free with your own home as a safety net, you're still making payments on the age pension. This is the hidden cost no one is talking about. Not just the extra $300,000 in interest, the extra 40 years of payments, but the fundamental reshaping of what retirement looks like in Australia. Let's look at the big picture. 40 years mortgages are being sold as a solution to housing affordability. But in reality, they're a band-aid on a bullet wound. They address the symptom, the monthly serviceability, without fixing the underlying problem, the housing supply, the investment incentives, and the wealth inequality. The real issue isn't that mortgages are just expensive monthly. It's that house prices are fundamentally too high relative to income. And extended mortgages does not fix that magically. It just allows prices to climb even higher. Think about the incentive structure this creates. Banks love longer mortgages, more interest income, developers and sellers love longer mortgages, higher sale prices, existing property owners love longer mortgages, their equity grows faster. The only people who don't love long-term benefit are first-time buyers who are thinking they're getting a solution, but actually they're getting deeper into the debt for the same or the worst outcome. Now, I'm not saying 40 years mortgages are evil or that no one should use them. For specific situations, that might be an older borrower who needs short-term cash flow or someone with specific investment strategy. That makes sense. But as a broad solution to housing affordability, they're definitely a trap. They create a short-term entry point that gets swallowed up by the market forces. They transfer more wealth from the borrowers to the lenders, and they extend financial obligations across your entire life right into retirement. Now look, I get it. If you're a first-time buyer watching this, it's frustrating that you are being told one thing by the bank and the politicians and another thing by videos like this. But here is what I want you to take away. Housing affordability isn't a problem you can solve with clever loan structures. It's a systemic issue that requires systemic solutions. More housing supply, reform taxation and investment incentives, and policy that prioritizes housing as shelter and not just investment. Until those deeper issues are addressed, every solution like a 40-year mortgage will just shift the problem. Now, what do you need to do as a first-time buyer? You need to be financially disciplined. You need to have a 4-pillar system in place for you to help lead the life, enter into the property market a lot earlier, a lot faster, and in a lot sleeker fashion. Now, if you found this valuable, hit that subscribe button, hit that like button. I break down complex property and economic topics like this every day. Drop in a comment below and let me know. Are you considering a 40-year mortgage or are you staying away? I read every comment myself. So thank you for watching. Take care, stay safe, keep smiling, keep investing. This is Mox checking out. I'll see you in the next one.